The Great Recession of 2008 had a lot of people questioning what a recession was and why it happened in the first place. History provides invaluable lessons to economists who study economic downturns and upturns, but it is also important for the average citizen to understand how consumer behavior may impact markets, especially those that end up in a significant decline. Everyone is wondering whether the economy is going into a recession, or if we are already in one. Today we will tell you what causes an economic recession. 7. What is a recession? A recession is a significant economic downturn spread across the economy that lasts more than a few quarters. More specifically, recessions often get boiled down to a simple definition: when gross domestic product, GDP, declines for 2 consecutive quarters. This prevailing line of thought, popularized by economist Julius Shiskin in 1974, only captures a small corner of a recession's true scope. The National Bureau of Economic Research, NBER, declares when we're in a recession. The nonprofit research group tracks the change in business cycles, including recessions. They determine when a recession starts by measuring a variety of indicators such as decline in real GDP, decline in real income, rise in unemployment, stagnation of industrial production and retail sales, decline in consumer spending. Fluctuations in just one of these factors aren't enough for the NBER to signal an alarm, which is why Shiskin's 2-quarter system isn't the most accurate model. However, these factors are certainly intertwined. For example, if a rising percentage of the workforce finds themselves without jobs, consumer spending is sure to decrease. 6. Recessions in the business cycle. To understand the macroeconomic variables that constitute recessions, Giacomo Sant'Alego, PhD, a senior lecturer of economics at Fordham University, says it's important to acknowledge the relationship between recessions and the business cycle. A business cycle tracks the up and down fluctuations natural to any capitalistic economies. Because the cycle traces the wide-ranging upward and downward co-movements of economic indicators, it is often a focal point for monetary and fiscal policy as governments attempt to curtail the effects of these peaks and valleys. Note, monetary policy is carried out by the central bank, while fiscal policy is carried out by governments. In fact, recessions are considered to be a normal part of the business cycle. According to the NBER, there have been 33 recessions in the United States since 1857. Business cycles are understood as having 4 distinct phases. Expansion. The phase represents a period of economic growth, also considered the normal phase of a business cycle. It is often characterized by an increase in employment and a swelling of consumer spending and demand, which leads to an increase in the production and cost of goods and services. Peak. The highest point of a business cycle that signifies when an economy has reached its crest of output. Here, there's nowhere to go but down, sending the economy into a contraction phase. This can happen for any number of reasons. Either investors get too speculative and create an asset bubble, or industrial production starts outpacing demand. This is commonly seen as the turning point into the contraction phase. Contraction, a period that is marked by a decline in economic activity, often identified by a rise in unemployment as well as a bear market. Additionally, GDP growth falls under 2%. As growth contracts, the economy enters a recession. Trough. A peak is to an expansion what a trough is to a contraction. A trough marks the bottom of a business cycle's economic activity and marks the start of a new wave of expansion and a new business cycle. This is a turning point that's followed by a new wave of expansion. It's important to note that business cycles do not occur at predictable intervals. Instead, they are irregular in length, and their severity is reflected by the economic variables of the time. That said, the average post-World War II business cycle lasted 65 months, according to the Congressional Research Service. 5. What causes a recession? Generally speaking, expansion and growth in an economy cannot last forever. A significant decline in economic activity is usually triggered by a complex, interconnected combination of factors, including economic shocks, an unpredictable event that causes widespread economic disruption, such as a natural disaster or a terrorist attack. The latest example is the brief recession that occurred as a reaction to the COVID-19 outbreak. Loss of consumer confidence. When consumers worry about the state of the economy, they slow their spending and save whatever money they can. Because close to 70% of GDP depends on consumer spending, the entire economy can drastically slow. High interest rates. High interest rates make it expensive for consumers to borrow money. This means that consumers are less likely to spend, especially on major purchases like houses or cars. Companies will also reduce their spending and growth plans because the cost of financing is too high. Deflation. The opposite of inflation is deflation. This is when product and asset prices fall because of a large drop in demand. As demand falls, so do prices as sellers try to attract buyers. Consumers see this downward trend and wait for those prices to fall, further reducing demand. The downward spiral reduces economic activity and increases unemployment, which causes an ongoing downward spiral or slow economic activity and greater unemployment. Asset bubbles. In an asset bubble, the prices of investments like tech stocks in the dot-com era or real estate before the Great Recession rise rapidly, far beyond their fundamentals. These high prices are supported only by artificially inflated demand, which eventually dissipates and the bubble bursts. At this point, people lose money and confidence collapses. Consumers and companies cut down on spending and the economy goes into recession. 4. What are the indicators of a recession? Economists determine whether an economy is in recession by looking at a variety of statistics and trends. Factors that indicate a recession include 1. Rises in unemployment. 2. Rises in bankruptcies, defaults, or foreclosures. 3. Falling interest rates. 4. Lower consumer spending and consumer confidence. 5. Falling asset prices, including the cost of homes and dips in the stock market. All of these factors can lead to an overall reduction in the gross domestic product, GDP. The European Union and the United Kingdom define a recession as 2 or more consecutive quarters of negative real GDP growth. In the United States, the National Bureau of Economic Research, NBER, tracks multiple economic indicators, including those listed above, to determine whether the U.S. economy is in recession. For example, the NBER declared a recession in the early 1990s, even though the GDP contracted inconsistently over 3 non-consecutive quarters. 3. The yield curve is an indicator of recession. The yield curve is another indicator of recessions, and one the NBER uses to predict or declare a recession. A yield curve is a line on a graph that tracks the interest rates of bonds that are equal in credit, but have different times at which they mature. A common yield curve looks at U.S. Treasury debt at 3-month, 2-year, 5-year, 10-year, and 30-year maturity benchmarks. There are 3 different types, or shapes, of a yield curve that indicate different stages of economic expansion and contraction. 1. Normal. A normal yield curve means that longer-term bonds have a higher yield than short-term bonds. This is expected behavior and generally indicates a healthy economy and a positive economic growth rate. 2. Flat. A flat yield curve means that longer-term bonds are beginning to have yields that are about the same as those for short-term yields. This means that the economy is in transition or approaching a recession, as investors are locking in longer-term bond rates before they decline further. 3. Inverted. An inverted yield curve is one where longer-term bonds have a lower yield than short-term bonds. This is an indicator of a recession, as it suggests that interest rates are falling or will continue to drop. 2. How do banks contribute to recession? Consumer confidence is key to keeping banks and their processes in equilibrium. After the Wall Street stock market crashed in 1929, panic spread, and consumers began pulling money out of banks, further worsening the situation, which we now know resulted in the Great Depression. Banks take in deposits from their customers and lend those deposits out to borrowers. The banks promise depositors that they can get their money back whenever they want, and at the same time, promise borrowers that they only have to repay their loans slowly on a fixed schedule. This system gives both depositors and borrowers the sense of certainty they need to plan their lives. But to accomplish this, the bank must absorb and then manage a very specific type of risk, the risk of a run. 1. How do you fix a recession? In most cases, governments can mitigate and reverse downturns by printing more money, then effectively loaning it out at low interest rates. These lower interest rates make it easier for households and businesses to borrow money from banks. In turn, the additional loans banks are able to inject more money into the economy, thereby allowing it to recover from the recession. Do share with us in the comments how we can prevent or survive recession. Thanks for watching.